Seth Kalarman's alarm on investment. We have all heard about the Oracle from Omaha, but what about the Oracle from Boston? According to famed Professor Bruce Greenwald at Columbia Business School, Warren Buffett once said that he would only invest with 3 outside managers if he ever decided to retire and stop managing money on behalf of Berkshire Hathaway. One of them was Seth Kalarman from the Barpost Group. In this video, you will learn the key components of Seth Kalarman's investing, which has allowed him to turn $30 million from 1983 into $30 billion today. But before that, hello and welcome to MoneyIQ. Join our channel by hitting subscribe and clicking the bell icon to be updated on our new uploads. You will also learn what his current portfolio looks like and about his biggest current holding. Yes, and it's an online marketplace. This is the Swedish investor bringing you the best tips and tools for reaching financial freedom through stock market investing. The Oracle from Boston, president of the Barpost Group, is pretty much unknown for most people, but Klein's overall track record speaks for itself. He's become a billionaire through investing in a Warren Buffett way, and his firm, the Post Group, has grown to manage more than $30 billion in assets after starting with less than 30 millions. The 63-year-old investor with a reported net worth of $1.5 billion and an alumni at Harvard Business School also has a stake in the Boston Red Sox and owns various racing horses. After graduating, Kalarman worked for Mutual Sharks Corp., which was run by value investing guru Max Hine. Later in his career, Goldman was recruited by adjunct professor Bill Purvu to help him manage a pool of capital just south of 30 millions. The company was named Barpost, as you know. Now this turned out to be a ride of a lifetime, headquartered away from the noise of Wall Street in Boston. Well, billionaire investor Seth Kalarman underlined the risks to investors of speculation, complacency, and both inflation and interest rate hikes in his latest annual letter to clients, a copy of which was obtained by Insider. The Barpost CEO, nicknamed the Oracle of Boston because he invests similarly to Warren Buffett, also highlighted the importance of hedging, explained why he wants volatile markets, and bemoaned the state of American democracy. He noted that current markets had brought plenty of opportunities due to the pandemic-related dislocations and several megatrends. The trends, Kalarman pointed out, included political uncertainty, government interventions, climate change, and technological disruptions. He added that these factors combined with the typical market inefficiencies result in rapidly moving opportunity creation that requires flexibility. According to Kalarman, Barpost's strategy is especially suited to investing during times of disruption, uncertainty, and unpredictability. According to Kalarman, he added that Barpost's primary success factors include its long-term flexible investment mandate, experience investing amidst great uncertainty, intellectual honesty in a rapidly evolving world, appreciation of optionality, and a record of assessing and mitigating downside risk. How Barpost uncovered value in 2021. Over the last several years, one of the great debates has been whether value investing is dead. It looked like value stocks started to make a comeback in 2021, but growth stocks remain popular among all types of investors. Whenever they have identified an opportunity, the Barpost team considers several questions. They think about why the opportunity exists, identify the market inefficiency, and consider whether they have lowered the bar, making investments appear more attractive than they are. Before they invest, the Barpost team also thinks about why their competitors haven't jumped on the apparent mispricing. Kalarman says that one of their primary drivers of capital deployment in 2021 was finding opportunity well off the beaten path. They don't buy high-flying stocks in hopes that they will continue to soar. Instead, they focus entirely on valuation and business fundamentals with a goal of growing capital over 3 to 5 years instead of over a week or a quarter. Where Barpost invested in 2021. One area in which Barpost uncovered opportunity last year was in commercial real estate, which Kalarman said experienced pandemic-related shortfalls in the capital. Due to the pandemic, occupancy levels were lower than usual, leasing activity was limited, and construction was delayed. Baupost seized upon the opportunities created by these funding gaps, which enabled it to inject fresh capital into the temporarily struggling real estate projects. For example, the fund invested $380 million into high-end condos in New York City's Central Park Tower and closed on 3 other lending opportunities in 2021, including a mezzanine loan to another condo project in Texas. Baupost has also identified and either closed on or expects to close on more opportunities to build lab space, cold storage, and data centers. Real estate made up about 11% of the fund's portfolio at the end of 2021. Baupost also invested in a number of private equity, credit, and credit-like opportunities last year, most of which range from $50 million to $200 million in size. In 2021, the fund deployed $1.6 billion of fresh capital into private equity, and it has another $1.2 billion of deal flow in the pipeline that Kalarman expects to fund this year. Portfolio additions in 2021 included Campo, the greatest European garden products business, which a distressed Chinese seller unloaded. Baupost also invested in a chain of veterinary surgical hospitals and a group of orthodontic and pediatric dental practices. About 13% of the fund's portfolio were invested in private equities at the end of the year. Kalarman also identified opportunities in the bespoke private credit and preferred stock markets. For example, Baupost invested in companies trying to secure growth capital without equity dilution or giving up control and other proprietary sourced financial opportunities. The fund deployed over $1.2 billion of gross capital in the space and had $1 billion in future transactions in the pipeline at the end of the year. About 3.5% of Baupost's portfolio consisted of private credit-like investments at the end of the year. No more free lunch. It's coming. Further, he noted that a short-term mindset has taken over the market as investors have experienced very little downside volatility in recent years. They're dabbling in companies with very long-term business plans as they aim to generate short-term profits on their trades. Kalarman believes the 12-year-old buying frenzy is like a roach motel that has lured many investors into speculative investments that are easier to get into than they will be to get out of. Investors have essentially been trained to believe that the government will always support asset prices when the world surprises to the downside, resulting in a sort of free lunch. However, Kalarman expects the debt to come due at some point. Eventually, the Federal Reserve will face constraints on their stimulative policies like those imposed by rising inflation. He believes that governments will stop being masters of their own fate at some point and that the markets will take charge. What the markets are currently saying about the hawkish Fed? It's no secret that the global markets are responding to expectations of a more hawkish Fed this year. Investors have been looking for clues about the number of interest rate hikes to look for this year and the pace of tapering the central bank's bond purchases. Current expectations range from 4 to 5 hikes of 25 basis points this year. The last inflation reading showed that the Fed must act to keep the economy from overheating, but it is severely constrained in what it can do because of its years-long accommodative policies. The question now is whether investors will turn their attention back to company fundamentals after years of ignoring fundamentals and investing without regard to what a company might be worth. A cheeky like and subscription will be very much appreciated if you did enjoy it. Thank you so much for watching, guys, and I'll catch you next time right here on the Money IQ. Bye-bye.